Okay, before we head in, just a couple of announcements. For the AI for Finance module, the Monday video that will be put up, we'll be covering critical thinking models and frameworks. We're going to cover root cause analysis, Socratic questioning, first principles thinking, second order thinking, and inversion. This is sometimes called systems analysis if you're more from the engineering side. For root cause analysis and Socratic questioning, we'll use ChatGPT and Gemini, both the language and the reasoning models, and we will be the inquisitor. And we will be looking at the copper argument, and I'll show you how to get that done. And you can then use any argument that you want with these models. For first principles thinking, we're going to look at AI and jobs, and we're going to break down our argument of the first principles. That's the idea. You break it down, you state a couple of first principles, and then you build your argument back up. The technique for inversion, we will also use copper. So we'll use it here, then we'll invert it, and we'll do it again. This over here, by the way, is where I got ChatGPT to give up. It did in the end say you win, which shocked the hell out of me, because usually these things don't relent. Like, they won't change their mind. It changed its mind. I'll show you how that happened. And on Discord tonight, I have a live. I don't do the lives on YouTube anymore. I do them on Discord live at 6 p.m. For the Globex Open. If you are not on Discord, again, let me tell you, go to markmeldrum.com. and you can register for free. There you will have the level 1 CFA from 2018. That will help you with your asset classes and some basic knowledge to participate in this game. From there, if you click on any module, let's say you click on the level 1 folder, you'll get another screen with a whole bunch of categories. On the right of the screen, you'll see the Discord link right here. Click on that and you'll show up at Discord. Right? I'm not asking you for anything. I'm not asking you for anything. I'm trying to push you in the way of where there is some good finance education for you. And my hope is that while you're going through this, you become addicted and you decide that, you know what? I can do it. I can do it. It's Sunday morning, 8:25. A press briefing is going on at the Pentagon right now. I watched the first 20 minutes. The general is answering the questions as best he can. Hegseth is praising dear leader as best he can with every answer that he gives, which he has to. That military parade of which he was in charge was a disaster. I seem to think he's going to be the first one to be fired. But now I have a dilemma, which I seem to have more often than not, is what do I talk about? It almost seems as if the past week, whatever happened this past week, is now meaningless because this is the only thing that matters. This guy is pure and distilled volatility. So at least we know we have that. So let's see what we have over the past week. It was kind of a quiet week, given that we had a Fed meeting. I expected a lot more volatility in yields, not so much in rates. No one expected a cut. We didn't get a cut, and let's get a brighter color on there. And why are we not getting the color I want? There it is. And money market rates were pretty much flat. Yields, look at this, like the 30-year, 1 basis point, the 10-year, only 3 basis points. In the right direction. TLT did squeak out a small gain on the week. SPY squeaked out a very small loss on the week. You can call it basically unchanged based on the percentages. So even though it was volatile in terms of the expectations, actual price action on the ground had low volatility. Looking at our next meeting, and by the way, just my opinion on this last meeting, they had full permission to cut. They chose not to. I think, on looking back, that's going to be a mistake. Looking at the next meeting, 14.5% probability of a cut. down from 23%, and you had one Fed official on Friday that gave a speech suggesting that, yeah, we can cut in July. Canadian CPI in 2 days. We have Powell testimony in 2 days and 3 days. Well, one for the Congress, one for the Senate. I would look for some Republican politicians to beat the crap out of Powell, because they will be performing for an audience of one. So they're going to want to do their best to tell Powell he's stupid and an idiot. Durable goods in 4 days. As I'm going down this list, I'm thinking to myself at the back, the back of my brain, does this matter? Like, are we really going to be looking for durable goods in 4 days, depending on how this plays out? What happened this weekend? GDP, the final look at Q1 GDP we get in 4 days. Mexico, we get a rate decision in 4 days, and US PCE in 5 days. I look for no surprises there. It usually comes in lower than the CPI. It follows the CPI, usually in the same direction. The components of the CPI that feed in, and same with PPI, that feed in to PCE, were all lower. So look for a rather benign number on that one as well. Reverse repo sitting at 138, reserves at 3.3 trillion. Let's put a T on that. Not moving very much, and the TGA sitting at 383. As far as auctions this week, there's a 2-year auction on Tuesday, a 5-year auction on Wednesday, and a 7-year auction on Thursday. The effect of this attack, I don't really know. You can make the case for yields, that yields would go up and that yields would go down. Yields should go up because this is really heightened geopolitical risk. And money should find its way into a safe haven, which at this point, it's still the US dollar. It would still be US Treasuries. But the other side of the argument is, if the US is drawn into another forever war in the Middle East, they're going to have to issue even more debt. The deficit's going to get even worse, because this was certainly not planned for in the big, beautiful bill. So the forecast of the deficit, if this is going to be an ongoing thing, that's going to have to get bigger. So you can make the case that yields could go up because of risk haven. Yields could go up because of the anticipation that they're going to have to issue more debt to finance these upcoming operations, if they're going to continue, or that yields would go down because of a flight to safety. If this is a one-off, then you don't need a flight to safety. If this is not a one-off, then there's the tension. Do you want the safety beat the expectation that the U.S. will have to issue more debt? I don't know. I thought Trump was going to send out the military, but bill countries for using the military. I wonder if he's going to bill Israel for this one, or if this one is gratis, free. I don't know. We are, call it flat on the inversion here. The 2 to 10 still strongly upward sloping. You have some Fed speak this week, but again, I'm not sure how important it's going to be. Monday you have 4, Tuesday you have 3, Thursday you have 2, and Friday you have 3. I think there are a couple of Fed officials now jockeying for Trump's attention in their speeches, indicating that they would be willing to cut rates. I don't know that that's going to affect markets very much. Looking at Fed funds futures for the end of the year, going out to January, we're pricing in the 2 cuts. The SEP still has 2 cuts for this year. I seem to think they could go more, but it has 2 cuts for this year. And then Q1, another 20. So you have 3 cuts in 6 meetings. If you go out to May, you get a 7th meeting in there. It's pricing in 3 cuts. For 3 cuts out of 7. If you go all the way out to next October, there are 10 meetings between now and next October, and they're pricing in 4 cuts over the next 10 meetings. I think that's wrong. So that to me seems like a fairly easy purchase. I am long ZQ. 4 on the October of 25, 15 for the January of 26, 13 contracts for May, and 10 contracts for October. I think you'll have one cut by October, which would put this at 95.92. And I think if it got to 95.92, I'd be willing to close these 4 and probably roll them all the way to next October. Real rates all came down. Look at the 5-year. Big moves in real rates here. 12 basis points. Lower real rates are supportive for equity prices. If we think about a company's income statement, you have revenues as your top line, and revenues are in nominal terms. So if you have inflation, your revenues will increase even if your quantity doesn't increase, because you get inflation by a general rise in the price level. Well, who's raising the prices? It's the companies, right? So discounting at a nominal rate might only include the inflation expectation built into the rate that caused revenues to increase. So if we think about discounting and in terms of real rates, this is what really matters for the present value of cash flow. Lower real rates are supportive of higher present value of cash flows. And inflation expectations up across the board, which question mark on that. CPI, PPI are rather benign. So I don't know why we have this move here. Sort of puzzling. Nothing going on here. This is just a big pile of nothing going on there. Look at that. You could just cut and paste every week. 6.81 still on the 30-year, tied very close to the 10-year. NAHB coming in at 32. This is a diffusion index where 50 represents neither expansion nor contraction. This is month over month. The housing sector has been in contraction, and then the next month contracting from the previous, and on and on. The previous was 34. The expectation was 36 was for contraction, but only at coming in below 50 at 36. Came in at 32, worse than expected. Housing starts in May, negative 9.8, and to be very, very clear, this is month over month. That's not year over year. That is month over month, down 9.8%. Permits down 2%. These are leading indicators, because if you start a house, well, it usually takes 60 days to build out a house. That speaks to the demand for employment for the people who, the contractors you use to build out the house, and demand for the materials to finish the house. And permits are a leading indicator of housing starts, and they're down 2%. So high rates are really hurting the housing market. However, if we look at the last, I think it was Zillow's report, housing prices year over year increased like an anemic amount. It was like 0.4%, and they are expecting that over the next year, housing prices will drop by 0.7%. Supply, they estimate, is about 20% above demand. The best supply conditions since 2020. But still, demand is just really, really depressed. Even though supply is greater than demand at this point, demand is really depressed. That if you had demand at normal levels, given this supply, you still have a structural shortage of housing in the U.S., but right now you have a lot of properties on the market still at these high levels. You haven't had a lot of price drop yet. Here is the SEP from the Fed. None of it good. Absolutely none of it good. But I want you to keep something in mind. If you go back, let's go back 5 years, and you look at the SEPs, you get 4 of these a year. So you'd have 20 SEPs. And you can see what they projected and what actually happened. These guys are bad at forecasting. So even though they're forecasting what they're showing here, they're very bad at forecasting. Let's just keep that in mind. They're very bad at this. March projection. Look at this. This is change in real GDP projected 1.7. Now they've said no, for 2025 it'll be 1.4. So growth got lowered. 2026 growth is lowered as well, doesn't return to their target till 2027, and then stays at 1.8 in the longer run. I kind of think that's low, given the technology and the pace of technology and technological change today. I think that's low. Also, given the concentration of where most of the AI investment is going, I think that's wrong. I think that's light. For this particular year, for the year we're in, for 2025, 1.4. These are my forecasts. I think it'll come in lower than 1.4. I think the long run is higher. I think you have a higher trend growth rate of real GDP, but this year will come in lower. Unemployment rate 4.4 to 4.5 this year. Next year was in March, they said it will improve. It's like, no, it'll stay at 4.5, and then it'll begin to improve in 2027, but won't get to the 4.3. Long term, they think 4.2. I think both this year and long term will be higher. I think you can expect a long-term growth, a long-term unemployment rate of about 6.5%. If you have AI for Finance, if you have the Applied Analysis series, AI for Finance, on Monday, I will lay out that argument using a first principles argument, which is one way to construct an argument. So I'll use that technique with AI, and what we'll do is we'll state our first principles, and then we'll build up our argument from first principles. And I get to about mid sixes on the unemployment rate. So I think this will be higher in the long term, but I also think this will be higher as well. And I think the difference is going to be increased productivity because of AI. But I do think that this is probably set to go higher by the end of the year. So I do think that your change in GDP will be lower. I think this will be higher, and that is permission to cut, right? I think that is permission to cut rates. PCE 2.7 to 3, 2.2 to 2.4, and 2 to 2.1, just higher across the board, and not getting to 2% until some longer run. I think this comes in lower. AI is massively deflationary, and it is accelerating. Every week I've been showing the impact in terms of jobs. We're going to do another screen this week. Every week there's announcements. Every week there are announcements of layoffs because of AI. And if you're doing it and you're my competitor, I have no choice but to do it. This is a Red Queen effect. The Red Queen effect is an academic term that implies, it's from Alice in Wonderland, that implies that you have to run just to stay in one spot. And when your competition are doing things, you must do the same things just to stay equal with them. So I think that this is going to be much lower. Now, there are base effects. And so the inflation rate year over year would appear to increase because of the base effects. Not that it's increasing, it would appear on a year over year basis because you have a rate of inflation, and if it goes sideways like this for a while before it goes back up, this is the base. So the next year, if you're just running a certain amount over, right, and let's say your month to month is rather benign and you're doing this, notice how low it is in here year over year, but then you have this increase in this period of time because the base effects are lower. It appears that inflation on a year over year basis is increasing. I really don't think the Fed is that naive to say, oh my God, inflation is going up. I think they're smart enough to recognize that, well, these are base effects. This is something about 12 months ago. This is not about what is going on. I think they'll look at the 3-month annualized, the 6-month annualized, the 1 month, and the month over month, and ignore the base effects. I think the natural pathway to this is downwards. I think the natural pathway to this is upwards, and this is going to be downwards before it's upwards. But longer run, I think, is going to be much higher. Shorter run, I think, will be lower. The core, same thing, same trend. So they're forecasting core inflation to be higher, PCE to be higher, unemployment to be higher, GDP growth to be slower, and we're not going to do anything with rates. I think that is a big mistake, and the housing market is just cratering. You have a forecast for a drop in housing prices, and for 68% of households, a large chunk of their wealth is tied up in their house. And you keep rates higher for longer, that wealth starts to melt away. Federal funds, 3.9. So still 2 cuts for this year. But next year, 1 cut less than they forecast. And for 2027, 1 cut less than they forecast. The combination of what I think is going to happen and just the financing of the debt and the cost of getting that done, you can't keep rates at this level. You will only make things worse over the long term if you try to do this over the next 3 years. The Treasury, I think, targets a duration on their debt of about 6 to 6.5. So they tend to lean more towards the front end of the curve and the money market than they do relying on the 20 and the 30 year. So it's a lot of 2s, 3s, 5s, 7s, and 10s. A lot on the money market, lighter on the 20 and 30. If you think about it in that way, with an average maturity of about 7 years, 7.5 years, you've had high rates. Now we're going on 3 years. If you're going to go another 3 years with these high rates, you're basically rolling over the equivalent of almost all your debt at these higher rates. So the interest expense on the debt can only go up because you have deficits that add to the debt and rates. And when they're rolling over a 10-year in 2025, that 10-year was issued in 2015, 100 basis points lower. You have some 5-year debt that was issued in 2020, 2021 at very low rates that you're talking under 1% that are going to roll over here. Where's our 5-year? At almost 4%. That's a 400% increase in the cost of the debt on that issue. This is unsustainable. The Fed is going to have to, at some point, coordinate with the fiscal and say we have to make decisions for the fiscal sanity of this country, not just for price stability and full employment. I think you can check the box on price stability. The lack of ability to look forward here is surprising. Now, in the press conference, he was asked about the effect of AI, and I don't think that his answer was informed enough, that perhaps he doesn't use it enough or he doesn't use it well to see what it can actually do. Let's have a look at copper. And this one here is probably my top pick for the next 3, 4, 5 years is a long copper position, but long copper, not a copper miner, long copper itself. On Monday in the AI for Finance module, I'll be putting up a video. We'll be looking at different methods of building arguments. One is root cause analysis. Another is a Socratic method. And we're going to use ChatGPT and Gemini. We're going to see which one performs better. We're going to use both the LLM in each one and the reasoning model to see which one performs better on this. And we're going to run a copper thesis through this. We'll be the inquisitor. And we'll see what happens. For ChatGPT, I did get it to submit. Usually these things don't give up. They just keep going and going with no matter what you throw at them. But I did get ChatGPT to say, you're right, I'm wrong. So I'll show you that on Monday. The July contract sitting at 483.40. About 5 cents in there is the carry versus where the spot is. September sitting at 488.45. You can see also another incremental 5 cents in there per quarter, roughly. And you can get the cost to carry by taking the underlying, multiplying it by 25,000, which is the number of pounds per contract, and out of it you can extract what the cost of carry is, because you can look at what a 3-month T-bill rate is. SOFR will be very close to the 3-month T-bill rate, and then you can back it out and get it, what it is per pound. Margin on HG is about $4,000. HG is high grade copper. Declines. So these are some of the things supporting, I think, higher copper prices. You've had declines in ore grades, down 40% over 35 years. Chile, which is a big copper producing region, yields per ton are down 30% over the last 15 years. So every ton of ore you take out of the ground has roughly about 40% less copper in it. In Chile, it has 30% less copper just in the last 15 years. There's shifts from open pit mining to underground mining. You got to go deeper to get more and more copper, so your costs increase when you go from open pit to underground. And if the costs increase, the price has to justify the cost, otherwise you leave it in the ground. So the price to get it out of the ground, the price must go higher. This is why I don't want a miner, because as the price goes higher, it is more expensive to get the copper. The costs go higher. So it's not as if it's a great benefit to copper miners at this point. If it actually just costs more to get the same copper, that is why you're getting higher prices. I'd rather just bet on price. By 2035, the forecast is about 200 copper mines will be fully depleted by 2035, and new discoveries are down 80% since the 1990s. So you have far fewer new discoveries. You have yields that are dropping. You have more and more expensive ore to get out of the ground. If prices don't go up, that ore doesn't come out of the ground, you are giving up on that much more copper. Let's look at, this is more on the supply side here. Let's look at some demand side stuff. 2025, January, this is just January to May, EV sales globally, 7.2 million. And, I thought that EV sales had hit their peak and were pretty much going sideways. That's up 28% year over year. EV sales are still hitting records. An EV takes 83 kilograms of copper versus 23 kilograms in an internal combustion engine. And look at that, up 28% year over year. Green energy, onshore wind takes about 3 tons of copper per megawatt. Offshore wind is 8 tons of copper per megawatt. Solar, 5.5 tons per megawatt versus 2.5 tons for conventional energy. And you're going to have massive build-outs in the U.S. and I think in other parts of the world. If you are going to continue on with the growth in EVs, you are shifting from the gas station to the utility. Well, the utility is going to have more generation of power somewhere, and generation is one thing, but transmission is another. There's your copper, right? Hyperscale data center, 30,000 to 60,000 kilograms of copper. So EV sales seem to be increasing. Green energy, there's more money going into green energy projects, maybe not in the US, but you still have the rest of the world. And we do know that there are more data centers being built. The supply of copper is under pressure. The demand for copper is increasing. Almost every source in the copper industry is forecasting a deficit this year all the way into 2027, 2028. And we're just sitting under $5 right now. We've tried twice at the $5 level, holding kind of tight, $4.25. I've got some 480 puts that expire in July, that expire July 28th. The underlying is the September contract. When we talk about the cost to carry on these contracts, that's not entirely true. There really is no cost of carry. If you bought 25,000 pounds of copper at $4.80, you'd be roughly $120,000. So you can buy $120,000 of copper and you'll get whatever the change in the copper price is. Or you can buy a contract that gives you access to that much or exposure to that much, and you could put this in a T-bill instead. Well, this T-bill would earn carry. The contract would have negative carry. So that they cancel each other out, which is the same thing as buying 120,000 pounds of copper, except you don't have to and worry about storage. It's all wrapped up in one contract. That's called delevering the futures contract. If you don't delever it, if you say, well, I'm not going to put 120,000 away, well, then you're basically using leverage, right? So the return on this is a leveraged return, but you are going to have to give up the cost of carry, which is every time you roll that contract over, you're going to lose about 5 cents of whatever gain you get. So if it goes up 20 cents over the quarter, you'll only experience 15 cents of that, but you really only put up $4,000, right? So yes, it's got carry. It's got negative carry if you're long, but it is eliminating you from having to put that much money out, that if you did have the 120, you can keep it in a T-bill and you have no cost to carry, and you have access to the same thing that the futures contract gives you. So this is all I'm really doing is I'm not really buying the copper contract. I am selling puts very close to at the money on these, and I did 10 contracts at 480. Be careful with this one. This is $25,000, 25,000 pounds a contract. Every 10 cents is $2,500, right? So if this drops 10 cents, I got 10 contracts. That puts me down 25K right away. If it drops a buck, you're down 250,000. I did get 0.146 out of this, so that's about 36,500 in premium for doing that. And I want to get more aggressive with copper, so I'm just going to keep at it, because I don't see the demand for moving electrons around, for transmission dropping. In fact, I see it increasing. If you think about a more digital future, you're going to need more data centers. If you think about a more electric future in terms of vehicles, you're going to need more utility generation and transmission. Other than the US right now, the rest of the world is still pursuing investments in wind, in solar. That takes a hell of a lot more copper. So I think given where copper is right now, this is an amazing trade to be in. This is not a momentum trade, though. It can't be a momentum trade. If you have a stock, call it ABC, it has so many shares that are outstanding. You can contrive all kinds of stories about what the future of that company will be. And the price will go up because people will be attracted to it. And analysts will then begin to raise their price target for no other reason than the price is going up, which will then fuel the story. And that story can get bigger and bolder. And you can make up whatever story you want about the future because it's all in the future. You can't really do that with copper. You can think about the future and the deficit of copper that will exist, even in a base case scenario. But we have inventory reports. So even if you drive the price of copper up with momentum, what are miners going to do? They're going to try to put as much onto the market as they possibly can. Well, momentum is not going to affect demand. Not going to see the price going up and EV makers saying, we better make more EVs now that the price is going up. That doesn't work that way. So it's not going to affect demand, but it will affect supply, and you'll end up with supply greater than demand. So you'll see inventories rise, which will put downward pressure on copper, because I'll go to your warehouse and you'll say $5.20 a pound. I'll say, look, there's lots of copper around. I'll go somewhere else and get it for $5.15. So you're going to sell it to me for what clears the market. So it's rare that a commodity will experience a lot of momentum, because the story can only be as big as the next inventory report. And if you have a build in inventories, well, it's obvious that you can see it. Whereas with an equity, you don't get a build in inventories, you get a vision of the future. And if it's far enough in the future, you can keep that momentum alive for quite a long time, because the promise of the future, as long as you keep people looking at the future, it's hard to do that when you got to report these inventory numbers So copper, I think, has very good, strong fundamentals, but don't look for these parabolic moves up like this kind of move in copper and this kind of move in copper. If you start seeing that, that's unsustainable. So if this starts doing this, I would say that somewhere around 540, 550, I'd be saying, okay, look, copper doesn't move that way. But if you take some point here, this is November 2023, and here, and you look at this, that's about right. Look at this attractor point, right? There it is again. There it is again. There it is again. There it is again. This just doesn't hold. That can't hold these big parabolic moves. And same thing, this kind of thing, that can't hold either. These big drops. So if you get something like this, I would say that's a buying opportunity. Something like that. But if you get this nice move up over time, I think that probably makes a lot of sense. And I think over a 5-year period, on a compounded annual return basis, if you're looking for about 12% on this one, I think that's probably about right. And this is a form of alpha. Now, I should mention on that previous screen when I said about 12% a year, that's a price return. You're using a futures contract, which is levered, so the return is going to be much greater than 12% per year. But on an unlevered basis, you can either get 4.33 in a T-bill, or you can get 12% on copper pricing. But again, if you're going to be levering that price, I think the price increases over the next 5 years, 12% per year, annualized, averaged over those 5 years makes sense. But lever that up, and you can do quite well. Let's look at where we are on SPY forward, 4-quarter operating earnings, holding tight at 269. Closing SPX 590, 59.67. So we're still over 22 times on the forward multiple versus 22.17. Call that unchanged for the week. We could see SPX was very little change, down 0.15%, TLT up 0.37%. Slightly higher implied volatility. Let's see what happens when the market opens at 6 p.m., when Globex opens. By the way, if you are on Discord, I do have a live in the stage, a live open at 6 p.m. because, well, let's see how it opens. Bitcoin is down. Bitcoin took a leg down on the news of the bombing, but then came back up a little bit. Still sitting at about 1024, 1025, not really giving way to the downside, signifying that, yeah, it's a risk event, but maybe it's not that big of a risk event. Let's see how the market opens at 6. Let's see where futures are. Let's see where oil futures open up. I think it'll probably show up in oil. So that is at 6 p.m. All-time high, February 19th. We can see it's the all-time high slowly moving this way on the chart. Every week it moves 5 more bars over, right? We are 2.78% below that. And for triple Qs, 2.56% below that, with small caps still significantly underperforming on a valuation basis. IWM, I would consider to be, it's under its longer term valuation. It is, I think, undervalued. I think it can probably benefit from AI on a relative basis, not absolute, but a relative basis more than large caps. And I think this is overvalued. I think we have to move to the downside here. So I am still short on SPY, and I am still long on IWM. I have net positive beta on that, but I will be looking at paring both of these down over time. Last week I made the case that we have to move away from the taco trade because Trump now knows he's being called the C word, chicken. And I said we have to start thinking about the ego trade for our positioning. Keep in mind, well, we had what happened this weekend. He's no chicken, right? And we have reciprocal tariffs still coming up. You still got that to get through, right? You still got that. And now that he's got this bombing thing behind him, he might be feeling a little bit more emboldened about his true strength. I don't know that the negotiations for reciprocal trades get easier because of this. I think they get harder. I think he's willing to go stronger on that one. Because, of course, you're only 3%. You got 10% across the board tariffs. You got 25% on vehicles. You 50% on aluminum, steel. And the market's saying, it's okay. It's okay. And if the market is up this week, if the market looks at Iran and says, we don't really care, then that is going to give his ego all the permission in the world to go really hard on the reciprocal tariffs because they need revenue. They need revenue. Revenue comes from taxes. Tariffs are taxes. Period. So you've got that in front of you. So don't be a hero. Maybe long term you think, well, the U.S. market is the place to be. And I think long term the U.S. market is the place to be. Long term, I don't know about the next couple of months. Heck, I don't even know about the next couple of days, to be honest with you. It's just, we get so much volatility. Although if you're looking over here, somebody might say, well, what volatility? Even if you go out here, that doesn't look like volatility to me. Look at the size of the wicks. Look at these big wicks up here. For anybody who's into candlesticks, these giant wicks all to the upside, these big wicks to the upside, that is bearish. So the size of the candle is small, but if you look from wick to wick, there's a lot of movement in the course of the day. I would seem to think a rational move at 6 o'clock when Globex opens would be to the downside. That would be rational. But do we still get the buy the dip mentality? And the rational move on treasuries would be up, but in the morning, do we get a sell the rip mentality? I don't know. I don't know what breaks that narrative, but that is what we have for now. 9 companies reporting this week. Wednesday, I've got just a few of them down here that seem to be of interest. Paychecks on Wednesday, they've been holding very tight to about 150. That is a quality company. If you're looking for low vol and a quality earnings, it's Paychecks. FedEx, they had some unfortunate price action on their last reporting. I don't know that this weekend heightened global tensions, along with tariffs and the looming threat of reciprocal tariffs, would be a condition for FedEx to affirm or raise guidance. That if I had to bet, I'd say either they affirm or lower guidance, but I think a raise of guidance is off the table on this one. You have Micron. Micron has had quite the run. It was down in the 70s for a while. Now it's in the 120s. It has quite the run, so its guidance is going to be important. And you have General Mills. Friday, Nike. And since we're in that space, I've been watching LU since it dropped after earnings. It dropped to about 250. With earnings momentum, whenever a company reports great earnings, they tend to drift in that direction for a while. Whenever companies report bad earnings, they tend to drift in that direction for a while. They'll get this little bounce in there, but then they tend to drift in that direction. They bounced at about 250, and then now they're sitting somewhere around 220. That is almost a 5-year low on Lululemon. I'd be interested in selling some puts on that one. I've been watching that one for a while, and I think it's drifted down far enough. But if Nike does bad, it is going to affect everybody in that category. Everybody that sells sporting wear or casual to sporting wear will suffer as well. So Lulu would have to fall to like 210, even to 200 for me to want to sell some puts ahead of Nike. But I will wait to see. As of now, I'll wait to see. And if it's bad, this will probably take another leg down. Then I will do it. Okay, let's spend some time with AI. A big part of my thesis of lower rates is AI pushing more and more into organizations. and eliminating more and more tasks, and with that, eliminating some jobs. Monday's AI for Finance will have a first principles argument on this one. We bring the argument down to first principles. We'll say 4 or 5 things that we can all agree on. Then we'll build an argument up from there, and I'll make the case at that point that I think the longer term unemployment rate will be somewhere around 6.5%, and that under one scenario, prices will be stable but not increasing, but under almost all other scenarios, price level, I shouldn't say prices, the price level would decrease, meaning deflation, not just disinflation, outright deflation. Let's have a look at some of the headlines I find. And by the way, these are easy to find. That's why it's so shocking that the Fed is not paying attention to this. It's not like I got to dig around for these headlines. If you have Apple News and you keep clicking on all the AI stories, eventually your news feed will be full of just AI stories. And these things just show up. So I'm not really going out of my way to find this stuff. And because I'm not going out of my way to find this stuff, this tells me that this is a contagion. If I had a company and I was seeing these headlines, I would be thinking, I better do something as well. If my competitors are doing something and the environment is doing this, I better get in on this. The share of Canadian organizations, this is the Globe and Mail for this first part over here. Share of Canadian organizations reported using AI to create goods and services in the past 12 months has doubled from 6.1 to 12.2. Still a low percentage. So you think about how much more you have to go, right? You're only at 12%, but it's doubled in one year, according to StatsCan. It's a survey of 21,000 Canadian business nonprofits also show AI adoption is more likely to reduce rather than increase staffing levels, particularly in healthcare and social assistance fields. Now, this one here surprised me, healthcare, because if we listen to some of the stronger names in AI, LeCun, Hinton, Marcus, they're talking about that's the one section that would be almost immune from it, one sector that would be almost immune. So that was interesting. I didn't dive into the report, but that raised sort of a question mark, saying maybe I should look at that. I can see social assistance, sure. In the past year, look at this number, 84.9% of organizations that adopted AI used it to reduce tasks previously performed by employees. And I think that's the first thing that organizations are going to notice, is that this can get rid of this task. It may not get rid of a job, but it can get rid of a task, which means I don't need as many newer people. So as the organization begins to scale up, if AI is taking a bunch of tasks away from my existing staff, that means my existing staff can grow and do more before I have to hire someone. Where would that show up? Entry-level jobs, right? And what are we seeing with new graduates this year? Brutal market for new graduates this year. That is a wicked number. I want you to just think about these. 85% that adopted AI used it to reduce tasks previously performed by employees. And the most common uses include text analytics, data analytics, and chatbots. According to Hadrian Merkins Kirkwood, a senior researcher at Canadian Centre for Policy Alternatives, surveying organization leaders might not take into account the more subtle ways that employees are already implementing AI, which is an important point. Now, your survey is picking up these numbers, but it's not picking up the fact that, well, what if employees are using it, even though organizations haven't really sanctioned it? What if employees are already using it as well? Your survey's not even picking that up, so it actually might even be more than that. Lots of workers are still using AI systems and not revealing it to their employer. You're going to be hard-pressed to find a workplace in this country where no one is using AI. Read that again. You're going to be hard-pressed to find a workplace in this country where no one is using AI. I would, if you, and I've said this before, if you go back 6 months to now, the progress has been mind-blowing. If you haven't used it, if you still have in your head, well, I used it last year, it wasn't that good, use it again and take the time to ask it good questions. You will be amazed at where it is. Let's go to another Canadian story. This is about a Vancouver software company, Clue Labs. a SaaS company. Preparing to lay off up to half its workforce, or about 100 people, to reposition itself for artificial intelligence. Only 100, but you have to look at the magnitude. Half its workforce. Makes AI-powered business intelligence tools for sales professionals to gather information on competitors. Has to reboot as a result of AI, according to Mr. Smith. Generative AI tools have become more adept since the release of ChatGPT in late 2022, forcing software as a service companies founded before that date to drastically rethink operations. Sorry about that noise. This is from another source, Hinton. He's a Nobel Prize winner for his work in AI. He's at University of Toronto. Hinton believes that jobs that perform mundane tasks will be taken over by AI, as roles like receptionists and customer service representatives are already vulnerable. That, Hinton predicted, will wipe out a high number of roles right off the bat. You'd have to be very skilled to have a job it couldn't just do. And this is the argument that I've been making in AI for Finance, is if we map the abilities of the LLMs and the LRMs onto Maslow's hierarchy, and I've been doing them as even amounts. A better way to do it is like this, where you have maybe about 30% of the area of the triangle represented by metacognitive knowledge and the rest by cognitive knowledge. AI is killer down here, which means you have to be very skilled. And this is what he's saying here. You'd have to be very skilled to have a job it couldn't just do. McKinsey, 30% of U.S. jobs could be automated by 2030. Goldman Sachs, 50% of jobs fully automated by 2045. Shopify, OpenText now have an AI-first strategy, meaning if you want to hire someone, you must show me why AI can't do it first before we hire someone. So we're going to expand on this argument a bit more. So in the AI for Finance on Monday, we are going to do the copper analysis. I'm going to show you how you can use AI to do root cause analysis and Socratic questioning to purify your arguments. If you can beat the LLM or the LRM, you know you have something. And I was able to beat OpenAI. We're also going to be reducing this argument. Is it going to create jobs? Is it going to take jobs? We're going to use this framework up here, the cognitive skills. I wouldn't say skills. These things are more, and I've called them this before, CDEs, cognitive domain emulators. We're going to use this framework to reduce our argument to first principles, and then we're going to build up from first principles to determine, well, what is AI's effect on jobs, being that we've all agreed on some basic statements that we can all agree are true. One of them that I make is that this is a general purpose technology. You can either agree or disagree. It's hard to disagree with that, but that's a pretty easy statement to start with. So if you start with a whole bunch of first principle statements that you can read and say, okay, I broadly agree on that, then we can logically build up to what the AI's effect on jobs are going to be. And by doing that, I get to about a 6.5% long-term unemployment rate for the U.S. I think this is a little much. I don't disagree with the 30%. I think that's probably true. Of the existing jobs today, 30% of them could probably be done with AI. But that then opens up the opportunity for new jobs at the metacognitive level that there just wasn't bandwidth before, plus new jobs in new categories that would be created at the metacognitive level as well. So I'm not with these numbers. Maybe on existing jobs today, sure. I mean, the car got rid of a huge industry built up around horses, right? Got rid of that. All of those jobs disappeared, but it created so many more jobs. This one is different. This technology, and I will show you using this paradigm how this technology is different than all the other technologies. So we can't go on the basis that, oh, technology creates new jobs. It will create some new jobs, but it will destroy a lot of existing jobs. And using Schumpeter's creative destruction, it will destroy before it creates. This is what we're heading into. This is, and we get the evidence everywhere. Every week, it's not hard. It's not hard to find these. That should be a clear sign for the Fed that these are not hard to find. These are not stories you hear every now and then over here and over there. This is one where you can walk into any large business or any SME, and they're going to tell you a story about how AI is changing the way they think about certain tasks and certain jobs. Anyways, that's the end for this week, 9:22 a.m. on a Sunday. We have, what do we got, 6, 7, 8 hours and 38 minutes from this point to figure out how the market is going to... Actually, that's not true. Sorry, 5:15 Eastern Time, 5:15 p.m., the currency market's open. So there's going to be, if there is fear, there's going to be an effect in Forex. The US dollar should be very strong. If it's not, then maybe it is a combination of, well, people still don't want the US dollar, or it's a nothing burger. And then we open at 6. So what are the things to watch at 6? Well, oil is going to be the big thing. That's CL and BZ. So you got Brent and West Texas. Gold, GC, is going to be another one that I would watch. And of course, whatever the futures open at. These are the big ones to watch at 6. And you got the currencies at 5:15. I will be on Discord at 6 p.m. Eastern Time for the open. And let's see what happens.